Hey everyone, welcome back. Today we're talking about something that's on a lot of people's minds right now, especially if you're nearing retirement or already there. With all the recent market turbulence, the talk of tariffs, and the rising cost of living, many folks are wondering, what now? And what are retirees actually doing while everything feels like it's in free fall? Well, here's a fact you might not know. Retirees in what's called the retirement danger zone, those 5 years before or after leaving the workforce, can be hit the hardest during market drops. A small mistake here, even just a bad year, can change your financial outcome forever. And with the recent market sell-off triggered by sweeping tariffs under President Trump's administration, a lot of Americans are suddenly in a very different financial reality than they were just a few months ago. So if you found yourself checking your accounts more often than usual, canceling plans, or just sitting there wondering whether you should pull your money out or wait it out, you're definitely not alone. This is something people all over the country are working through together. And that's what we're going to talk about today. What people are really doing, what's working, and how to approach all of this with a little more calm, a little more clarity, and hopefully a better plan moving forward. Before we go any further, if you find this kind of content helpful and you want to stay informed without all the noise and panic, feel free to hit that subscribe button. It really helps support the channel and keeps this community growing. Now let's start with what actually kicked this all off. The big drop in the markets didn't come from a bad jobs report or some sudden tech collapse. It came from a policy announcement. President Trump put broad tariffs in place against almost every major trade partner. We're talking about countries like China, Canada, the European Union. And of course, those countries responded with tariffs of their own. It was kind of like watching a giant economic ping pong match. Only, instead of small white ball, it was your retirement accounts bouncing around. In just 2 days, the S&P 500 dropped more than 10%. The Dow lost over 2,000 points. The Nasdaq fell 6%. And global investors, retirees included, watched about $5 trillion in value disappear. That's a hard hit, especially for people who aren't in the workforce anymore and don't have the same tools or time to recover. Now, this brings up something really important. There's a specific period in financial planning that a lot of people aren't aware of, and it's called the retirement danger zone. Basically, it's that window of about 5 years before and after you retire. It's a sensitive time, and if the market crashes during those years, it's not just stressful, it can seriously cut down how long your savings last. Let me give you a simple example. Imagine 2 people retiring at the same time, each with $1 million saved. One of them starts with a 20% gain. The other one takes a 20% loss. Even if the rest of their returns are exactly the same after that, the one who started strong ends up with over $1.6 million after 30 years. The one who took that early hit, their money runs out in just over 20 years. That's the sequence of returns risk. And right now, it's not just a financial theory for a lot of retirees, it's a reality. So what are people doing about it? Well, for starters, there's definitely been a mix of panic and planning. Understandably, some folks are scared. They've worked hard their whole lives, and now they're watching the value of that work drop every time they open their app or check the news. But here's the thing. History shows that the biggest gains often come right after the biggest losses. JP Morgan actually looked at this and found that if you missed just the 10 best days in the market over a 20-year period, your returns would have been cut almost in half. Miss 30 of those days, and you'd be underwater once you factor in inflation. That's why a lot of financial advisors are urging retirees not to react too quickly. Instead, many are shifting their focus to what they can control, building cash buffers, rethinking spending, and adjusting their strategies in ways that are thoughtful rather than reactive. One practical move that keeps coming up is having at least a year's worth of living expenses set aside in cash. That way, when the market is falling, you're not forced to sell at a loss just to cover your bills. It gives you breathing room. And if you don't have that buffer yet, some advisors recommend starting to build it up now, even if it's just a little at a time over the next few months. That small shift can make a big emotional difference too, not just a financial one. Another thing people are doing is getting strategic about their withdrawals. Some retirees are postponing their RMDs, those required minimum distributions, and moving them into cash early in the year. That helps reduce the chance of needing to sell investments in a down market. Then there's spending. Many retirees are scaling back. Vacations are being put on hold, and home renovations are being pushed to next year. Big purchases are getting reevaluated. But interestingly, some are doing the opposite when it makes sense. Here's what I mean. Because of the tariffs, prices on certain goods are expected to spike soon, especially imported items. So if you're already planning to buy something big like a computer, phone, or a new fridge, it might actually be cheaper to buy it now before prices go up. It's not about spending more. It's about timing the spending that was already planned. And also, more retirees are checking their portfolios to see if they're too stock heavy. For years, with the market doing well, it was easy to let the balance shift toward equities. But now, folks are reconsidering and aiming for something more balanced. Maybe enough in bonds and cash to cover 5 to 7 years of living expenses, with the rest still in stocks for growth. Some are even exploring other options like annuities or TIPS, which are Treasury inflation-protected securities. Others are doing Roth conversions while their portfolios are temporarily lower in value, which could lead to lower taxes down the road. But just like anything else in finance, each strategy has its pros and cons. Reverse mortgages, for example, are getting more attention right now, but they come with high fees and strict rules. So it's important to really understand what you're getting into and maybe talk with a planner before making a big decision. Another trend we're seeing is people adjusting how much they withdraw each year. The old 4% rule, where you take out 4% of your retirement savings every year and adjust for inflation, doesn't always hold up in rocky markets. More advisors are suggesting a flexible withdrawal strategy. So maybe take a little less when markets are down, and then give yourself a bit more in the good years. And yes, some people are even choosing to delay retirement altogether. Even working a few extra months can help. Not just because of the income, but because it lets your savings grow longer, delays Social Security claims, and shortens the number of years you'll need your portfolio to stretch. Now, of course, not everyone can keep working. Health, caregiving, and just the wear and tear of time can make it tough. And that's totally valid. As one advisor put it recently, time is a currency too. And you have to ask yourself, is working longer really worth giving up your most active years? Speaking of which, there's also a broader conversation happening right now about how policy decisions are impacting retirees. Some people feel like they've been left out of the conversation. These tariffs weren't designed with them in mind, but the consequences are real. Higher prices, market uncertainty, and now a need to rework their financial plans on the fly. Some retirees are taking matters into their own hands, calling lawmakers, writing letters, and making their voices heard. They want to remind those in power that behind every market stat, there are people, real people, trying to make their money last, try to live with some dignity and peace of mind. And while there's no one-size-fits-all solution here, there's still a sense of hope. Because here's the thing, many of today's retirees also lived through 2008. Some even remember the stagflation of the 70s. And what we've seen is that those who stay calm, make thoughtful choices, and stay flexible tend to weather the storm better. Markets will always rise and fall. Policies will shift. But with the right mindset, a few smart moves, and a little support from each other, this isn't the end of the story. It's just another chapter. So then, what does this mean for you? Well, maybe it's time to review your plan, or maybe it's time to sit down with a trusted advisor. Or maybe it's just about taking a deep breath and remembering that you're not in this alone. And if this helped bring a little clarity or reassurance today, I'd love to hear your thoughts in the comments. What changes are you thinking about making? What strategies have worked for you in the past? Let's build a conversation down there. And if you haven't already, don't forget to subscribe for more thoughtful financial updates like this one. Thanks for spending time with me today. Be kind to yourself, take things one step at a time, and I'll see you in the next one.